All right, let's jump right into this explainer. Today, we're decoding the visual battlefield of stock charts to figure out exactly how market momentum violently shifts. If you've ever stared at a price chart and just wondered how some traders seem to magically predict when a stock is going to fall off a cliff, well, you're in the right place. We're going to look really closely at bearish reversal candlestick patterns. Think of them as the footprints left behind by the market's biggest players. Picture this, a super strong uptrend just abruptly stalls out. What exactly is happening behind all those red and green bars when buyers suddenly throw in the towel and surrender to the bears? I'll tell you right now, it's definitely not random. It's a highly structured transition of power. And today, we're going to visualize exactly what that transition looks like. Here's our roadmap for today. First, we'll cover the turning point. Second, the psychology of a reversal. Third, the top bearish candlestick patterns. Fourth, how to confirm those signals. And finally, essential risk management.
So starting off with Section 1, the turning point.
These formations basically act as your early warning system. But here's the catch. They only occur at the absolute peak of an established uptrend. This is absolutely crucial, you guys. You can't have a bearish reversal if you're just sitting in a sideways or consolidating market. They represent that exact flashpoint where aggressive selling pressure finally overwhelms buyer demand, giving you the ultimate signal that we're shifting from an uptrend into a downtrend.
To really visualize this, let's contrast an uptrend with a reversal. Look, in a massive uptrend, buyers feel completely invincible, right? They're making higher highs, life is good. But the bearish reversal? That's the exact critical moment that invincibility shatters, the structural support cracks, and the whole balance of supply and demand fundamentally flips on its head.
Moving on to Section 2, the psychology of a reversal.
Okay, so when prices hit those historical resistance zones, the smart money, we're talking the big institutional traders, they start quietly booking their profits. They distribute their shares, basically trapping those late-stage retail buyers at the absolute top. We all kind of know that feeling, right? Buying in purely out of FOMO precisely when the smart money's already sprinting for the exit.
And man, this creates a brutal psychological trap. When prices suddenly drop, literally every single person who bought at that peak is instantly underwater. The shock of this sudden loss just totally shatters bullish confidence. And as those trapped buyers are forced to liquidate to cap their losses, it triggers this massive cascade of stop-loss orders. Basically a textbook avalanche of panicked selling.
All right, Section 3, top bearish candlestick patterns.
So we categorize these patterns by complexity and, more importantly, reliability. As you can see, they range from your single candle warnings, which honestly offer a pretty low strength signal that needs a lot of confirmation, up to double candle setups like the bearish engulfing. Then you hit the highly reliable triple candle formations like the evening star. The general rule of thumb here, the more candles involved in the pattern, the stronger your multi-session confirmation is that a total momentum shift just happened.
Let's kick things off with the single candle shooting star. You're going to spot this at the very top of an uptrend. You'll see this tiny real body way down at the lower end of the trading range, topped off with a massive upper shadow or wick that has to be at least twice the height of the body. This visual tells a super clear story. Buyers tried to push the price to new highs intraday, but the bears stepped in and violently shoved the price all the way back down. It's a massive rejection at a resistance level. Moving up to our double candle setups, we have the bearish engulfing and the dark cloud cover. Now, the bearish engulfing is an incredibly powerful visual. It's where a massive red candle completely swallows the previous day's green candle. Just pure, sudden seller dominance. The dark cloud cover is a little different, but just as telling. It reflects a morning where the price gaps up on all this bullish optimism, but then selling pressure absolutely collapses the price, closing deep below the midpoint of the previous day's green candle. Both of these patterns are literally screaming that the bears are taking over. Okay, now we've got to look at one of the absolute strongest reversal patterns in all of technical analysis, the bearish kicker. Why is it so strong? Well, because it's a violent gap down with absolutely zero overlap between the two candles. Just imagine a really strong green day followed immediately by a massive gap down right on the open. It signifies a sudden, total surrender by the bulls, often triggered by some surprise catalyst, like a huge earnings miss. It traps everyone who was long and practically begs for aggressive shorting.
If you're looking for maximum reliability, you want to hunt for those triple candle formations, like the evening star. I like to think of this one as a 3-act play. Act 1, a tall green candle showing clear optimism. Act 2, a small-bodied star candle gapping up, which shows hesitation and a sudden sort of equilibrium between buyers and sellers. And then Act 3, a dominant, tall red candle that closes deep into the body of that first candle. It perfectly maps out the shift from greed to hesitation to just aggressive fear.
And guys, this isn't just theory. It is backed by some serious hard data. Historical backtests running from 1960 all the way to 2023 show the Evening Star has a staggering 72% success rate in predicting downturns. No joke. But that reliability leans heavily on that third red candle acting with real authority, often wiping out over 60% of the first candle's gains.
Now, if you happen to witness the 3 black crows on your chart, which is 3 consecutive long red candles, each opening within the previous candle's body and closing near their absolute lows, you aren't just looking at a single day of panic. No, you are looking at sustained, systematic institutional selling. The smart money is basically offloading their positions day after day, completely crushing whatever uptrend was there before.
Which brings us to Section 4, How to Confirm Signals.
Let's talk about your execution protocol, because you absolutely have to follow a disciplined checklist here. Step 1. Identify the pattern at a valid resistance level. Step 2. Verify there's high selling volume. Step 3. Confirm momentum exhaustion with your oscillators, like the RSI. You're specifically looking for it to be overbought, up above 70. Or you can check the MACD for a bearish crossover. And finally, Step 4. Wait 1 to 3 days for bearish price follow-through. Seriously, never ever trade an unconfirmed candle.
Look, if you only take one thing away from this confirmation checklist, please let it be this. Volume is your truth serum. A beautiful evening star pattern on really low volume, that's just market noise. But a massive volume spike on that same bearish reversal candle, that confirms the institutions, the heavyweight players who actually move the market, are aggressively shorting and distributing their shares.
Finally, let's wrap up with Section 5, Essential Risk Management.
Here are your absolute survival must-haves when trading these setups. First off, the pattern has to occur in a verified uptrend. I mean, you can't reverse a trend that doesn't even exist, right? Second, you must always place a hard stop loss just above the pattern's highest point, which is your ultimate level of resistance. Third, map your trade out so you maintain a minimum 1-to-2 risk-to-reward ratio. And lastly, wait for the actual candle to close before executing. A pattern just isn't a pattern until that closing bell rings.
Crucially, this all comes down to the math of survival. You've got to size your positions based on the distance to your stop loss. This ensures that if that stop loss is triggered, you are never risking more than 1-2% of your total account equity on a single setup. Say a massive kicker candle makes your stop loss distance super wide. Well, you either wait for a pullback or you drastically reduce your position size to stay within that strict 2% risk limit.
By combining structured pattern recognition with these really strict risk limits, you completely transform your trading. You stop being a reactive, emotional trader who gets trapped buying at the top, and you evolve into a disciplined market tactician who actually capitalizes on the crowd's panic. The markets are constantly painting a real-time picture of human greed and fear. They're showing you exactly where the institutional money is quietly stepping in to reverse the tide. So, now that you know exactly what structural footprints to look for, the real question is, will you spot the next reversal before the crowd does, or will you be the one left trapped at the top?